problem 2 on Connect. This is exercise 1113, in your textbook. They talk about preparing an income statement using the contribution margin approach and the traditional or the GAAP approach. Let's go through and highlight some of the information because they tell us this company incurred $50,000 of fixed product cost. They also incurred $40,000 of variable product cost during the first year. They also incurred $16,000 of fixed and $13,000 of variable selling and admin cost. The company sold all of its units, so there's no beginning inventory to fuss with and no ending inventory. They made and sold every unit for $160,000. So, we have what we need. First of all, let's do the traditional, or the GAAP. GAAP stands for Generally Accepted Accounting Principles, not the place at the mall that sells blue jeans. So they had $160,000 worth of revenue. Well, that's the same under both the contribution margin format and the traditional format. You don't end up with more money because you count it differently. Now, the cost of goods sold includes their $50,000 of fixed product cost and $40,000 of variable product cost. So that's $90,000. Right? 50 and 40, yep. Just got to make sure. So that's my cost of goods sold. That's a subtraction. That gives me gross margin. This is just like we did a few weeks ago when we were doing this in the financial portion. Selling and administrative cost, again, they give us this. They give us $16,000 of fixed and $13,000 of variable. In the traditional format, we don't care if the costs are fixed or variable. We care what they do, not how they do it. So that's $29,000. In selling and administrative costs, both fixed and variable. That gives us net income of $41,000. Remember, this looks at what the costs do. Cost of goods sold reduces revenue to give you gross margin. Selling and administrative gives you net income. Contribution margin says, no, let's look at the way the costs behave. How do the costs act? They're the costs that I've underlined in pink. So we have $40,000 variable product cost and $13,000 variable selling cost. So our variable costs are $53,000. Our gross margin, which we really should call contribution margin, because we really don't consider this a gross margin, it's a contribution margin. It's $107,000. And by definition, a contribution margin are those funds that are available to pay fixed costs. Our fixed costs, they're the ones that I wrote in green, underlined in green. 50,000 fixed product cost and 50,000 fixed selling and general administrative. That's 66,000. And our net income is 41,000. Now, the next question is almost insulting. It says, surprise, how come both income statements give you the same number? Because you're counting the same money. They're both looking at the same expenses. It's not like you're looking at different expenses. You're simply looking at them in different order. In the traditional format, you're looking at the costs by function, and in the contribution margin format, you're looking at the costs by behavior. But in either case, you're still looking at $119,000 worth of costs, whether you want to subtract them 90 and then 29, or 53 and then 66, it's still $119,000 in costs.